the market actually doesn't follow that much of a normal distribution. The probabilities which normal distribution is assigning to offbeat events, for example, Nifty going to 24,000 or Nifty going to 21,000, the model will have a very low probability, whatever walls you put for the correct. But those extreme numbers, the extreme events are actually more common than your normal distribution suggests. If you see, the truth is the extreme events happen more frequently than what the normal distribution will suggest. Normal distribution will give a very low probability, but reality is that it happens more frequently. And hence, what people started doing used to be like they will buy very out of the money call and put extreme numbers like 21,000 put and 6,000 call and pay a small paltry amount and sit back. So what will happen? They will invariably make money because once in a while that number will trade, and whenever it trades, they'll make money. Correct? So how do traders who are selling options will take care of this? It's a arbitrage. You always buy out of the money option and sit back. You'll make money. So they wanted to increase this price, but they didn't want to change the Black-Scholes formula, because the whole market is using a Black-Scholes formula that's helping in trading, and otherwise it's working well. So how do you increase the price of out of the money options, deep out of the money options? So one of the ways they said, okay, if it is out of the money, then we will increase the volatility. So the market started quoting that if the option midpoint is here, this is, let's say, called 50 delta. We will discuss that delta later. So this option is somewhere 25 delta, the out of the money options, the wings. If for the wings, the volatility will be high. Implied volatility got increased for the wings, and that results into a relatively higher price of out of the money options, like a 25,000 call or a 21,000 put. That will be more expensive than what a pure normal distribution will suggest, because the volatility is going to be high.
Yeah, it's a think like this, that if you are a trader and somebody comes to you and says, I want to buy a very deep away from the market strike, you will obviously say, if right now the volatility is so much, but then if market does go there to such a level, at that time, not only the market is going there, even the volatility is going to be very different. So I will charge you higher number, right? Logically. So that number is basically means that as the volatility goes away from current market, or rather the spot goes from current market away, the vol number also spikes. So that's why you see that extreme differently very away strikes like 21,000 or 26,000, they are good at a higher vol numbers.
Now, so they increased the volatility and hence the price became more normal. So Black-Scholes again started working and everything fine. Then another phenomena has been observed. These options are there for quite some time, multiple decades. So another phenomena which is very common, is that the accidents happen more frequently on one side than on both sides. So it's not symmetrical. That is, whenever market crashes, the crashes are much more faster, like Lehman